Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, Daniel Snyder here from Seeking Alpha. This is another episode of ETF Spotlight. And today we have a great treat for all of you seeking income, but also love the tech-focused space as well as others, because we are joined today by Sirian Scalpone, who is joining us as co-head of client portfolio management for wealth investment solutions at Goldman Sachs. And we have to talk about this because this is the interesting space of tracking the indexes, but also using that derivative side of getting income, which I know a lot of people are focused on. So Sirian, thank you so much for joining us today. Was hoping we could kick things off. The GPIQ fund that you have over there at Goldman Sachs tracks the NASDAQ 100 and has the derivatives aspect to it. But just wondering if you might be able to dive a little bit deeper into how the fund is put together, as well as how investors might be able to utilize this within a portfolio.
Sure. Well, thanks for having me. Really excited to be here to talk about GPIQ. So GPIQ is what's broadly known as a derivative income ETF. So there's different flavors of these, but generally this refers to strategies that invest in stocks, as you said, and then sell options in order to generate income. So you might also have heard of these as premium income, options overlay, covered call, buy right strategies. That's a term that we use a lot. So generally a buy right strategy buys a portfolio of stocks and then writes or sells call options in order to generate income at earning options premium. And so these strategies can offer the capital appreciation of equities, but with more income and a little bit of a smoother ride. So we call it lower highs and higher lows. And this type of profile can make a lot of sense for income-seeking investors. And so GPIQ specifically is designed to deliver lower volatility exposure to the NASDAQ 100 index, while also providing consistent monthly distributions with an income stream that's diversifying from traditional fixed income. So it's one of two of our premium income ETFs. The other is GPIX, which offers this value proposition, but with exposure to the S&P 500 index. And so when we think about it, it's a solution for investors who want exposure to the NASDAQ index, but they might want slightly lower beta in addition to higher cash flow. And so since inception, GPIQ's provided 10.5% annualized distribution on a monthly basis. And importantly, since inception through April, GPIQ's also captured about 85% of the total return of the NASDAQ index. And so the way that it does this is through buying a portfolio of stocks that tracks the NASDAQ 100 index. That's the buy, part of the buy, right? And the buy part is passive. And so we think investors appreciate the transparency of having exposure to this very familiar index. But then, as I said, we're writing or selling call options, selling some potential upside in exchange for bringing in cash flow in the form of premium income. And so we think it can be a great solution for both non-taxable and taxable income-seeking investors. In a non-taxable account for older investors, for example, maybe they've been holding a NASDAQ tracking ETF for years, but as they age, they want to maintain exposure and reduce some volatility and increase income. So we think it's a great solution because it's a clean swap. In other words, it's very similar exposure, just lower volatility and higher cash flow at 10.5%. And obviously for a non-taxable account, there'd be no tax consequences of making this switch. And GPIX offers that similar value prop for S&P 500 investors. And then for taxable accounts, it's also a great solution because the majority of the cash flow has been distributed tax efficiently.
There's a lot to unpack there, obviously, but the premium income suite, specifically going into GPIQ, I think it's only an expense ratio of 29 basis points, if I remember correctly off the top of my head here, which is less than your competitors, which I won't talk about too much, right? But When you're looking at this, I
Okay,
mean,
feel free to talk
investors,
about
I mean,
it.
investors are always looking at the expense ratio, right? And they want to see, okay, well, is this the fund for me, and how much am I paying out, and everything else. But as you mentioned, reducing volatility. Maybe you could elaborate a little bit more on that, and how that actually helps in their portfolio. Like, how do you actually reduce the volatility by utilizing this fund?
Yeah. So because it is an options writing strategy, we're buying a portfolio of stocks that looks a lot, or it looks like the Nasdaq 100 index, but the active selling call options. In a down market, you can think about it as providing cushion on the downside, right? So we're bringing in that premium income by selling calls, and in a down or even flattish market, that premium income's going to cushion that down market. But then what we're doing is we are selling upside, right? We're capping or selling upside, and sort of capping some of the return of the market if the market is incredibly strong. And so we're going to have exposure to the NASDAQ market, but just with those lower highs and higher lows, so slightly lower volatility. Now, that doesn't mean that the fund has low volatility on an absolute basis. It's still, growth equity. It's lower with maybe a beta of about 0.8 to the NASDAQ 100 index.
Yeah, thank you for clarifying that. Now, obviously, people hear about selling options at strikes above and that sort of thing. They may not understand, how do you choose those strikes where the options get sold? Is that on a monthly basis, a quarterly basis? How do you approach it within this fund?
Yeah. So when we think about what we're generally doing is we're choosing at the money strikes for options, and we're selling monthly options, but on a weekly basis. And so the reason that we choose at the money strikes for the options, one is upside. So at the money options generally cost more, right, than out of the money options. So as a seller, you get more premium for a given level of coverage. So you can cover less and leave more of the portfolio uncovered to fully participate in market upside. Out of the money options are cheaper. So as a seller, you'd have to cover more upside for the same amount of premium. The other benefit is tax efficiency. So in a rising market, at the money options are more likely to result in realized losses versus out of the money options. And this can help reduce the fund's net capital gain and increase the tax efficiency of the distribution. So even though at the money options are more likely to go against the seller versus out of the money options, remember, because at the money options are more valuable, as a seller, we're able to leave more of the portfolio uncovered for full market upside participation during rising markets versus using out of the money options. And so generally tend to capture more upside. And this, this dynamic approach, we think is a huge component of our differentiated approach. So we think that we're trying to be active. We're trying to be active where it counts, right? We're trying to deliver passive exposure from the long equity component, again, delivering exposure to that familiar and transparent NASDAQ 100 index, but we're active where it counts on the dynamic options writing component, because we're adjusting the coverage ratio. We're adjusting how much of the portfolio's upside we're covering or selling based on the market volatility environment. So market volatility impacts the value of options. Higher volatility generally makes options more valuable or more expensive, and lower volatility makes options generally cheaper, right? And so as a seller, during a higher volatility market environment, we can actually bring in, a certain level of premium, let's say 10.5% for GPIQ. We can cover or sell less of the portfolio's upside, versus in a lower volatility environment, we may have to cover or sell more of the portfolio's upside. And so generally, the range of the part of the portfolio that we're covering ranges between 25% and 75%. And in this most recent bout of market volatility that we just experienced, we were covering, a lower part of the markets or of the portfolio's upside. And this was really important because during the rebound, because we were only covering a lower percentage of the portfolio's upside, during the rebound, our portfolio captured a lot of that market's upside.
So I want to double click here and go really in for the people that are watching right now to make sure that the audience understands, like, is this fun for me, right? So you're talking about this process of paying this almost 10.5% yield on a monthly occurrence, but you're actually selling those weekly option strikes to help fund that additional alpha, if you will, the cash distribution, correct? So for the investors that are listening right now thinking, is this my portfolio? Can you maybe talk about the distribution angle versus the long-term total gain angle and kind of clarify that for them?
Yeah, sure. That's actually a really important really important component. So this is something that income seeking investors should be paying a lot of attention to, is not just that headline distribution rate, but also what is the total return of the fund. And so the distribution rate is a component of total return. But when you think about it, think about like a 10% distribution. Let's say a client has $100 of NAV of the fund. A 10% distribution is going to be $10 of distribution, right? But then let's say the client's NAV declines to $80. Well, a 10% distribution on an $80 NAV is going to be $8. And so when you have these funds that are distributing a percentage distribution, what you really have to be thinking about is the total return, because what you don't want is a declining NAV and that distribution to erode the client's capital base, because that just means the dollar value of the distribution is also going to erode. And so when you look at the headline distribution rate, that's important. But what's also important is the fund's ability to maintain or even grow the client's NAV, right? You don't want that capital base to erode. We sometimes think about this as a melting ice cube effect. And so like the important thing for these income distributing equity funds is the high distribution rate. Sure, that's incredibly important. And for GPIQ, from our perspective, the consistency and stability of that distribution is really important. So we've been able to deliver that 10.5 distribution annualized on a monthly basis very stably since the inception of the fund. But also really important is being able to capture that market upside, being able to maintain and also have potential for capital appreciation of the equity markets so that ice cube doesn't melt and the client's distribution doesn't decline.
I'm glad you mentioned that, because there are those funds out there that are kind of like those hidden ice cubes just melting away, trying to sell people that it's the perfect fund for them. And it doesn't actually do anything. Let's be honest. So thank you for that. I want to wrap up here with one last question. You're at Goldman Sachs, so everybody's watching the income space that we're talking about here today, whether it's the NASDAQ 100, the S&P 500. There's all these ETFs that are out there. I'm just kind of curious, what is the firm's or maybe your personal stance on where this specific part of the ETF landscape is headed from here?
Yeah, so we think that derivative income ETFs, they are continuing to see really strong interest. I think there's about 22 billion in net flows year to date. And actually in Q1, it was the 5th highest flow category across all active and passive mutual funds and ETFs. And so we think these funds are going to continue to garner a lot of interest as the population ages. Investors are increasingly looking to, they want income. And they also want to invest in equity markets to maintain that capital appreciation potential, but with the lower highs and higher lows. And so, we think that interest is here now. And then additionally, with educational outlets like Seeking Alpha shining a spotlight on these strategies, we see interest, only continuing to grow. But that being said, income's not the only thing that investors are trying to solve for. So we're always evaluating the market dynamics and exploring opportunities to deliver other solutions or outcome-oriented strategies and active strategies to address a spectrum of needs across equities and fixed income. And so, in this sort of crowded landscape, I think we want to make sure that our investors understand that we're differentiated in our approach. So, first, I think that the consistency and stability of the distribution is really important, right? Again, 10.5% every month since inception on an annualized basis. Second is the strong market upside capture. So again, 85% of the NASDAQ index, the total return of the NASDAQ index since inception. And both of these are direct results of our dynamic option strategy. And then finally, as I mentioned, the tax efficiency of our distribution, we think that's a huge differentiator as well. In fact, of the 10.5% distribution, 9.75% is actually the after-tax distribution. So GPIQ investors have gotten to keep more of what they earn, about 92% of the distribution, even after tax. And so we think that this fund is differentiated in the landscape. And so our philosophy is to continue to put out differentiated solutions-oriented ETFs in this landscape that helps meet investors' needs.
Sarah, and music to my ears. 9.5% after tax. We all keep an eye on taxes. Let's be honest. So, thank you so much, Syrian Scapone, everyone. This has been another great episode of ETF Spotlight. The fund again was GPIQ from Goldman Sachs, tracking the NASDAQ 100, giving you that monthly distribution as well. Go ahead and check it out here on Seeking Alpha or anywhere across the interwebs. And we'll see you next week here back on ETF Spotlight. Take care.